Good news for home buyers and homeowners. In 2026, you can borrow more with a conventional loan before you ever touch a jumbo. Let's break down the new 2026 conventional loan limits and what that means for you. Hi, I'm John Thomas with Prime Residential Mortgage. In this video, I'm going to walk you through exactly what the 2026 conventional loan limits are, how much they increase from 2025, what a high cost area and a super conforming loan really mean, how to find your own county's limit wherever you're looking to buy or refinance, and how to use these numbers to plan your purchase or refinance. If you're buying in Delaware, Maryland, or Pennsylvania, or pretty much anywhere in the U.S. except New York, this will help you know how much you can borrow with a standard conforming loan. So, what are the 2026 conventional loan limits? Well, without further ado, let's start with the headline. Beginning January 1st, 2026, the baseline conventional loan limit for a one-unit property in the United States will be $832,750. If your property is in a designated high-cost area, the one-unit limit can go all the way up to $1,249,125. That's what we call a high cost or super conforming, and it's exactly 150% of the base. So here's the simple version. Most counties, you can borrow up to $832,750 on a one-unit home with a standard conventional loan. Certain high-cost counties, you can borrow up to $1,249,125 and still stay as a conventional loan. Anything above your county's limit will be considered a jumbo loan. So, what is a conventional conforming loan? Let's define a couple other terms because this confuses people. A conventional loan is a mortgage backed by Fannie Mae or Freddie Mac. It's not backed by a government agency like FHA, VA, or USDA. When your loan amount is at or below the FHFA limit for your county, we call it a conforming loan. If your loan amount is above that number, then you're looking for what's called a jumbo loan. So conforming equals at or below your county's limit. Jumbo equals above your county's limit. And remember, this is based on the loan amount, not the purchase price. How much did the 2026 limit increase? So how much did the limits actually go up? Well, in 2025, the base conforming loan limit was $806,500. For 2026, it's $832,750. That's an increase of $26,250 or 3.26%. The reason it changes each year is because FHFA uses their home price index, which tracks home prices nationally. Under a law called the Housing and Economic Recovery Act of 2008, they took a look at home price changes over the last 4 quarters and then adjust the baseline limit up when prices rise. Couple of key points. The limit can go up as home prices rise. If prices fall, the baseline limit doesn't go down. It stays at the higher number. That's why if you look back to 2016, these numbers have climbed a lot. All right, quick history. Let's actually look at the loan limit since 2016. Just go to some context. Here's the baseline unit for 2016. It was 417,000. So we're more than double that now. 2017, 424. 2019 was up to 484,350. 2021, 548,250. 2023 was 726,200. 2024 was 766,550. Last year, 806,500. And now going into 2026, 832,750. So what does this trend tell you? It tells you that more homes now fit inside conforming guidelines than in the past. That means a lot of buyers can stay in conventional loans instead of moving into jumbo financing. Now, what is a high cost area or what's termed a super conforming loan limit? Next question we're going to cover is what exactly is a high cost area. A high cost area is a county where 115% of the local median home price is above the national baseline limit. In those counties, FHFA allows a limit to go higher up to 150% of the baseline. 2026, that high cost ceiling for a one unit is $1,249,125. Loans in that higher band are often called high balance loans or super conforming loans. Here's the important part. They are still conventional loans that are sold to Fannie Mae or Freddie Mac. They just have slight pricing differences and some guideline differences. So you might see a small bump in your interest rate if you end up in a high balance or a super conforming loan. Some extra underwriting rules, possibly. Also, special areas like Alaska, Hawaii, Guam, and the U.S. Virgin Islands have higher baseline and ceiling limits than the rest of the country. Okay, how do you find your county's 2026 loan limit? Well, FHFA makes this very easy. They publish all the county by county loan limits on their website. Here's how to check. You go to the website. There's a link in my blog post and in this video description. And you're going to go to the conforming loan values map online. You're going to pick your state. Then from a drop down, pick your county, and you'll see the loan limits for 1, 2, 3, and 4 unit properties for 2026. If you don't want to mess with the website or spreadsheets, my team can pull this for you in a couple of minutes and then show you what it means in terms of price range and down payment. Okay, what if you need a loan above the conventional loan limit? Well, you're going to be in what's called the jumbo loan limit or non-conforming loans. You basically have two options when you're going above the conventional loan limit. Option one is all-in-one loan jumbo, or you can do a combo, first mortgage at the conventional loan limit with a second mortgage called a piggyback second. So let me give you an example of this strategy. Let's say you're buying a house for $1.3 million, 20% down, $260,000. That would put your loan at $1,040,000. Let's say your county baseline limit is $832,750. In that case, if you get one loan, you're above the conforming limit. Your $1,140,000 would put you in a jumbo loan if you wanted to do it all in one loan. Okay. The second option is we break that up. We get a first mortgage for $832,750, the limit, and a second mortgage for $207,250. So you have a first and a piggyback second. Which is better? Really depends on your credit score, your income, your debt to income ratio, your cash reserves, and how long you plan to stay in the property, because that'll affect the rate in terms for the jumbo and then comparing that to a first and a second. So really the best thing to do is get a lender like myself to do a side-by-side comparison, and then we can consult you on the pros and cons of each and help you make the right decision. All right. How do the 2026 limits help buyers in Maryland and Delaware specifically? Well, let's look at the local there. All 3 counties of Delaware, for example, Newcastle, Kent, and Sussex, have the baseline conventional limit, and they have for years. So for 2026, you're going to be capped at $832,750 in Delaware. Now in Maryland, it's more of a mix. Some counties, especially near Washington, D.C., might qualify for the higher loan limits, right? They could be high cost areas. Some areas of Maryland are the baseline limit. So we have to look up the county you're buying in and determine whether you're going to be at the baseline or you'll fall into a high cost area and can borrow more than you can normally. All right. If you fall into the conventional loan limit, you can do as little as 3% down as a first time home buyer, which is huge. So that means with the conventional limits, if you're under that, you can put way less down, whereas a jumbo, typically 20%, you could possibly do 10%, okay? So again, wherever you're buying, we'll look at the county, we'll tell you what the limit is, we'll offer you the options, we'll compare jumbo if you're going over the limit to a first and a second. If you're under the limit, then again, we'll have the conventional options with as little as 3% down. So let me give you a simple 5-step plan to use these new loan limits in your home search. First, look up your county's 2026 limit. Use the FHFA conforming loan limit values map, or just reach out to me. Step 2, decide on your target purchase price. Work backward from your monthly budget and your down payment. Remember, the limit applies to the loan amount, not the purchase price. You can buy above the limit if you put down more money and keep your loan at the cap. Step 3, get a full pre-approval, not just a quick pre-qual. With the John Thomas team, we do full pre-approvals so that you are basically walking in with almost a cash offer. We'll review your income, your assets, and your credit. We'll run your file through Fannie Mae or Freddie Mac automated underwriting to make sure you get the approved eligible. We'll confirm whether your conforming or a jumbo route makes more sense for you depending on the purchase price. And we'll compare conforming versus jumbo versus first and second options depending on where you're at, where you're buying, and what your terms are. We'll look at the rate differences, the payment differences, the closing cost differences, so you can see the numbers, not just hear buzzwords. And you're going to have a complete comparison. Step 5, coordinate with a real estate agent. Once we know your maximum conforming loan amount and your approved price range, your agent can focus on homes that actually fit your budget and run a search that meets your max purchase price based on the 2026 loan limits. This is especially important if you need seller paid closing costs or want to layer in down payment assistance programs, okay? All right, let's talk about common myths about conventional loans. Let's bust a few quick myths first off, okay? I hear all the time. The loan limit is based on the purchase price. That is not true at all. The loan limit is based on the county maximum loan limit according to FHFA. has nothing to do with the purchase price. The purchase price just determines how much down payment you need, okay? Myth 2, you can buy above the limit unless you put down 20%. Not true. You might use a jumbo loan or a conforming plus a second, sometimes with less than 20% down, depending on your profile, okay? Myth 3, loan limits are the same everywhere. No, limits are set by the county and by the number of units. Some counties get high cost limits and are much higher than the baseline. Myth 4, higher loan limits mean automatically qualify for more. No, higher limits only expand what's allowed under the rules. You still need to qualify based on your income, debts, and credit and assets. Just because the loan limits went up doesn't mean you qualify for more. Myth 5, Delaware and Maryland always share the same limit. That's not true. Delaware counties always share the same limits, but Maryland and Delaware counties can be different because there are some high-cost counties in Maryland. All right, how do you apply and get approved under the new 2026 limits? Well, give me a call, 302-703-0727, or you can apply online, www.prmiloanapplication.com. My team and I would love to help you get the keys to your brand new home.